What are mutual funds? A question most of us have in their mind, so let's understand that in today's lecture. Hello everyone, welcome back to channel, Study with Focus. Mutual funds are investment options that provide individuals with easy access to a diversified portfolio of assets such as equities, bonds, government securities, gold, and more. They are created by companies called asset management companies, AMCs, or fund houses, which collect money from investors, market mutual funds, manage investments, and facilitate investor transactions. Professional fund managers, who possess expertise in analyzing and managing investments, oversee mutual funds. These fund managers make decisions on behalf of the investors regarding where and when to invest, among other responsibilities. They allocate the funds collected from investors into various financial assets based on the mutual fund's investment objective. To cover the costs associated with managing the funds, the AMC charges a fee known as the expense ratio. This fee is not fixed and varies among different mutual funds. In India, the Securities and Exchange Board of India, SEBI, the capital markets regulator, has played a significant role in promoting the mutual fund industry. SEBI has established regulations that aim to benefit all stakeholders, including investors and mutual fund sponsors. These regulations are periodically updated to enhance the functioning of the industry, attract investments, and foster growth. How do mutual funds works? Mutual funds operate based on the concept of net asset value, NAV, which represents the price at which investors can buy or redeem their mutual fund units. When investors invest in a mutual fund, they are allocated units based on the amount they invest and the prevailing NAV. For example, if you invest 500 rupees in a mutual fund with a NAV of 10 rupees, you will receive 50 units of the mutual fund. The NAV of a mutual fund changes daily, reflecting the performance of the assets in which the fund is invested. If the value of the underlying assets increases, the NAV will rise, and vice versa. In the example above, if the NAV increases to 20 rupees, the 50 units you own will now be worth 1000 rupees, 50 units x 20 rupees. The performance of the mutual fund is driven by the returns generated by its underlying assets. When you decide to redeem your mutual fund units, you will receive the value based on the prevailing NAV. In this case, you would receive 1000 rupees for the 500 rupees you originally invested. The difference of 500 rupees is considered a capital gain. It's important to note that the market value of the mutual fund portfolio and the NAV are not fixed, but rather fluctuate daily based on the valuation of the underlying assets. Therefore, the capital gain can also turn into a loss depending on the movement of the NAV and the performance of the underlying assets. Since mutual fund investments are subject to market risks, returns are not guaranteed and can vary over time. Mutual fund returns, in the form of capital gains, are subject to capital gains tax. The tax is applicable when you redeem your investment, as in the example above where you would be liable to pay tax on the 500 rupees capital gain. It's important to keep in mind that the capital gains tax is only applicable upon redemption and not while staying invested. The extent of the capital gains tax depends on the type of mutual fund and the duration of your investment holding. Mutual funds are subject to both short-term capital gains tax, STCG, and long-term capital gains tax, LTCG, which are defined differently for mutual funds. The taxation of mutual fund returns can vary based on various factors. To learn more about how mutual fund returns are taxed, you can refer to specific tax regulations in your jurisdiction. What are the different types of mutual funds? Mutual funds can be categorized in various ways, including their structure, the types of securities they hold, and their investment strategies. Here, we provide you with a brief overview of some popular types of mutual funds to help you get started. Structure-based types. Open-ended funds. These mutual funds allow investors to buy and sell units at any time, offering liquidity and flexibility. There is no fixed maturity date, and investors can enter or exit the fund as per their convenience. Close-ended schemes. These mutual funds have a predetermined maturity date. Investors can subscribe to the fund only during the initial offer period, and redemption is typically allowed only on maturity. Units of close-ended funds cannot be purchased or redeemed at any time. Types based on asset classes. 1. Equity mutual funds. These funds invest a minimum of 65% of their assets in stocks of companies listed on the stock exchange. Equity funds are generally considered suitable for long-term investments, over 5 years, as stock prices can be volatile in the short term. They have the potential to offer higher returns but also come with higher risk. Some types of equity mutual funds include A. Large cap funds. These funds invest at least 80% of their portfolio in stocks of large cap companies. Large cap companies are typically among the top 100 stocks based on market capitalization. B. Mid-cap funds. These funds invest at least 65% of their portfolio in stocks of mid-cap companies. Mid-cap companies are generally ranked between the 101st and 250th positions based on market capitalization. C. Small-cap funds. These funds invest at least 65% of their portfolio in stocks of small-cap companies. Small-cap companies are typically ranked 251st and above based on market capitalization. ELSS, Equity Linked Savings Scheme, is a tax-saving equity mutual fund that invests a minimum of 80% of its portfolio in stocks. Investments made under ELSS are eligible for tax deduction under Section 80C of the Income Tax Act, 1961, up to 1.5 lakh rupees per annum. ELSS comes with a lock-in period of 3 years from the date of investment. 2. Multi-cap funds invest in stocks of companies across all market capitalizations, including large cap, mid-cap, and small-cap stocks. There is no investment limit defined by SEBI based on market capitalization. 3. International funds are mutual funds that invest in equity of companies listed outside India. These funds aim to provide geographical diversification to investors and counter the volatility of Indian markets, as foreign markets do not necessarily move in sync with Indian markets. 4. Index funds are a type of mutual fund that replicates a specific index. When you invest in an index fund, your money is deployed in the same companies and in the same proportion as the tracked index. For example, an index fund tracking the Sensex will invest in all the 30 stocks comprising the Sensex in the same proportion. The index fund adjusts its portfolio to reflect changes in the index constituents. 5. Debt mutual funds primarily invest in fixed income instruments such as government securities, corporate bonds, and other debt instruments. They are less affected by stock market volatility and generally offer more stable returns compared to equity mutual funds. Debt mutual funds are categorized based on the maturity period of the securities they hold. Let's explore a few types. 6. Liquid funds. These funds invest in debt securities with a maturity period of fewer than 91 days, offering a low-risk option for short-term parking of funds. 7. Overnight funds. These funds invest in securities with a maturity of 1 day, providing low-risk investment options. 8. Money market funds. These funds primarily invest in short-term government securities and similar instruments with maturity periods of less than 1 year, suitable for stable and non-volatile investments. 9. Banking and PSU funds. These funds invest at least 80% of their assets in debt securities issued by banks, public sector undertakings, municipal bonds, and public financial institutions. 10. Gilt funds. Gilt funds invest a minimum of 80% in government securities across various maturity periods, making them suitable for long-term investments. 11. Short duration funds. These funds invest in debt and money market securities, with an average portfolio maturity of 1 to 3 years, catering to investors with a moderate risk appetite and an investment horizon of 1 to 3 years. 12. Hybrid mutual funds invest in a mix of equity and debt instruments in varying proportions based on the fund's objective. They offer diversified exposure to different asset classes. Hybrid funds are categorized based on their allocation to equity and debt. 13. Aggressive hybrid funds. These funds allocate 65 to 80% of their portfolio to equity and 20 to 35% to debt instruments, carrying higher risk compared to balanced hybrid funds. 14. Conservative hybrid funds. These funds invest at least 75 to 90% of their portfolio in debt securities and allocate the remaining 10 to 25% to equity securities, offering relatively lower risk. 15. Balanced advantage funds, also known as dynamic asset allocation funds. They dynamically adjust their allocation to equity and debt based on market movements to maximize gains and minimize risks. So far, we understood about what is mutual funds and its types. However, a lot is left to talk about. How to invest in mutual funds, what are the modes of investments, minimum investment required to start investing in mutual funds, its features, benefits, advantages and disadvantages. We will cover that all in the part 2 of what is mutual fund. Stay connected to learn more. Hope you learned something new. Thank you.